Hey, financial patriots. Today's discussion, are low interest rates good? Or do they create inflation or housing bubbles? And what is the impact on retirement? This is Joe Gonzalez here, and welcome to Financial Patriots, surviving and thriving in the new world. And my mission is just to help people survive some upcoming changes that are definitely going to rock us all. And I just want my friends to be prepared for what's happening and to create some discussion and to possibly make some financial moves and decide for themselves what is good for them. This is not financial advice. This is purely for discussion and educational purposes. So I just want to kind of get everybody thinking. And so I just thought this discussion was good because, you hear a lot about interest rates and, hey, you see the headlines about mortgage rates are going down, another historic low, and now's a great time to refinance, and all those big headlines. So I just thought I'd put it into a perspective to make you think like a financial patriot. And again, financial patriots are all about surviving and thriving in the new world. So let's move on to what I believe might be happening here. So if we look at this chart, this is actually the historical 10-year US Treasury note rate for the last approximately 50 years. So you can see this, it started before 1970, it ends in 2020 today. And note the run up in interest rate in the 1970s, 80s when you had a period of sharp inflation. And then we peaked out at about 15%, 15.8%, I believe it was, in around 1980. And then ever since 1980, so many people haven't even been alive since then. If you're over 40 years old, I guess, look at the sharp decline in interest rates from 15.8% all the way down to today, which is about, somewhere around 1.2% or something like that. So my question for you is this decline in interest rates good for you, or does it actually create housing bubbles and inflation on the cost of housing for all of us? Remember, we have a debt-based economy. Every time you get one of these, a dollar bill, it's a Federal Reserve note. That means it's debt put into the system by the Federal Reserve and then multiplied by banks. And they, of course, want you to take out loans because that's how they make money. So the more loans they can supply, the more goods and that can be purchased by consumers. We're a consumer-driven economy based on debt. So what does that all mean? This is just a very simple example. I'd like you to just pay attention to the concepts. I do have my calculator right here, so I'm sure it's 95% correct. But look at this from 1980 approximately. So note the decline in rates since 1980s. The implication is this. In 1980, if you bought a $150,000 house and put 10% down, and financed $135,000 at a 14% interest rate. So somewhere in this time period right here, the 1980s, at a 14% interest rate with a 30-year mortgage, the monthly payment would be $1,581 on that $135,000 mortgage. So you can think, holy smokes, wow. I mean, how can anybody afford 14% interest rates? Well, a lot of people did floating rates back then and had to refinance, or they just couldn't do it. But variable rates were very high back then as well. And like I said, inflation was running wild. But in 2020, so if you look at today, and you think of a 3% 30-year fixed rate mortgage, I think the going rate is somewhere around 2.75 to 3.25. So let's use 3% interest rate. Okay, with a 3% interest rate, that same monthly payment of $1,581 would get you a mortgage of $375,000. So if you borrow from the bank for a monthly payment of $1,581, you could finance $375,000 versus in 1980 you could only finance $135,000. So the question for you is, have housing prices actually gone up? You hear a lot of people talking about the equity in their home and how housing prices have gone up. Did the housing prices go up, or is it really a $150,000 house that is now a $400,000 house? Who's that good for? Is that good for the seller? Is it good for you? What will happen if interest rates go up again? What do you think if house prices went up so much over the last few years, over the last 30 to 40 years? What's going to happen if we're no longer in this downward trend and we actually start to go upward like this? Well, wouldn't housing prices have to come down then? So I also want us to think was what happened to our wages in this same time period? So if you think about what's happened to our wages in this same time period, this is a chart showing the median household income in the United States from 1970 to 2014. Just a chart that I pulled up to show some data that would encapsulate the time period. But look at this. This is the middle class represented by the shaded the black area right here, actually. And then it's the upper class represented by the gray, and the lower class, lower wage earners, by the blue area. So let's go by the median household income. Let's say the middle class, $61,000 in 1980. Okay, so $61,000 in 1980, which was buying you an approximate $150,000 home back then. Okay, does that make sense? Now, what happens then in 2014? The median wages have only gone up to $73,000. Do you feel that squeeze? And by the way, look at what the wealthier upper class has gone and how their wages have risen. But look at the middle class and the lower class right here, the lower wage earners. I don't mean to say lower class, but look at how this squeeze has happened and why that wealth gap is getting wider and wider, because the median income, household income, only went from 61,000 to 73,000 in over a 30-year period. But here's the problem with that, and that is that these folks are now still expected to buy a $400,000 house versus what used to be a $135,000 house. So it's gone up 3 times, but their wages have not gone up 3 times. Pretty incredible when you just look at it. Now, I'll ask the question again, are low interest rates good for everyone? Here's the problem is our wages are not even keeping up with inflation. Now, here's the next thing to look at. This is the 30-year Treasury rate, and how do these same interest rates, the 30-year, which is a long-term bond, how does the interest rate impact retirement? Well, just look at it like this. In 1990, if you were able to retire, you could buy a 30-year Treasury bond, which the Treasury bond represents the risk-free U.S. Treasury. It's the strongest credit in the world. So at 8%, if you placed $1 million and bought $1 million worth of bonds at 8%, you could have $80,000 per year tax-free in retirement with that $1 million bond. And now let's put that into perspective. Today, those rates, because the trend of rates going down so much, if you put that same $1 million into bonds today, a 30-year bond, you would only make approximately $12,500 per year. So how does it even make sense that people can retire today? Do you see why there is such a struggle in the senior class, and the struggle for all of us to understand, are we going to have enough for retirement? Because this represents the riskless return, and what this forces everyone to do is actually go and put their money into the stock market instead of the safe treasury bonds, and it forces you to gamble your wealth in order to try to make a greater return than this 1.2%, and you try to make the 8% in the stock market. So the purpose of this discussion was just to show you that, low interest rates may not be that great for us. Do you see how these low rates actually create housing bubbles? Because what's going to happen if they move interest rates up? And does it make you think about what you're going to need to do in the future? Financial patriots are prepared, and should we think about eventual rising interest rates and maybe a housing price decrease? I know it's not happening this date as of October 2020, but is it something to think about that eventually we want to sell high, and then if the market and the housing crashes, do we then buy low again? Now, of course, it's going to be at a higher interest rate, but it's just something to think about. And again, this is not financial advice. This is strictly for education and discussion purposes. And I want to show you that low interest rates are not necessarily the greatest thing ever. It might feel like it's good because it can buy you more house, but it does impact you in other ways. And this is how our financial and our banking system actually entraps people and forces inflation on asset prices like houses. So I hope this helps, and hope this promotes some discussion. Leave your comments down below. Thanks.